All right. So how many of you trade cryptocurrencies? Okay. How many of you have looked at the cryptocurrency market today? Nobody? Nobody wants to look at it. Okay, well, so my name's Daniel Kari. I'm the CEO of a company called Pactum Capital. We are active traders of cryptocurrency. We do market making, arbitrage, and OTC. And we are going to talk about the economics of blockchain. I am not an economist, but I am somebody who has been looking at this for quite some time. I will let the other panelists go ahead and introduce themselves, and then we'll get started.
Hi, I'm Tammy Camp. I'm the CEO and founder of a company called Stronghold. We are a financial service provider that is native to distributed ledger technology. So we provide financial services such as payment settlement, OTC brokerage, market making, and we do some token tax optimization as well.
Hi, I'm Kevin Zhou with Galois Capital, co-founder Galois Capital. We also focus on OTC trading and algo market making. So I know Daniel pretty well because we trade together. Our firms do at least.
So let's talk about the liquidity in the market, I guess, to talk about it first. Kevin, do you want to get started? Maybe talk about some of the assets that you trade, maybe liquidity in the market.
Sure.
And then I'll let Tammy add in.
Yeah, so I think overall, given the current bear market, liquidity is really drying up, not quite what it used to be. And I think in particular, there are certain tokens where liquidity is just much worse off in spite of their high market cap than others. And I think a good metric you can take a look at is just what the daily turnover is over the entire market cap, right? So for Bitcoin, that's about 5%, right? So 5% of the supply turns over in Bitcoin per day. For Ethereum, maybe about 10%. And then, for some other coins, go down to something like Maker, which has a very high market cap, turns over maybe 1/400th of its market cap every day. So I think, even given similar market caps or something that, should be liquid enough to trade decent size, sometimes not quite is. And I think a lot of that is probably due to where it's listed. So if you get listed on Coinbase or Binance, immediately you have a lot more liquidity. If you're only listed on, let's say, decentralized exchanges, it takes some time for that to build out. Even if people really do support the project and do think the price should be very high, it takes some time to build out that liquidity. And I also think that overall liquidity is the sort of thing that really doesn't matter until it does. And at that point, it's the only thing that matters. There's a lot of these long funds that started up last year and this year that are in these positions, very concentrated in some of these smaller alts where they control 5-10% of the circulating supply. And if they're saying that on paper, they're marking to market and saying, hey, the profit looks like this or the losses look like that, in actual liquidation, when you actually have to realize those returns, may not be as good as it looks on paper. So I think before taking something of a sizable position in an asset, you should definitely think about the round trip and what it'll cost to get out of that position, and then whether or not you have a strong enough opinion to even undertake that in the first place. So that's just my thoughts.
Yeah.
Do you think I have anything to add?
I would say, since we also run a trading platform, I think the number one thing that we ask an issuer, so like a token issuer, somebody that does an ICO, is if they have considered market making, and do they consider liquidity, if that's really important to them. And I think that the more sophisticated the issuer, the more tools that they will use in terms of like market making and liquidity, and that might be a good signal in terms of like who you would want to back. It certainly is for someone that we consider to market make or to list, because they come with certain regulatory obligations. So it actually has to be worth it for us to, and from a regulatory standpoint, to to conduct the due diligence and then be able to present it in front of regulators, and then it have the correct ecosystem to support the viability of that issuance of the token on the platform.
I think one thing that people don't realize, and Kevin, you're discussing about this round trip thing. One of the things that my firm does as traders, we basically trade on what is an inefficient market. So there's a big cost into taking a big position and also getting out of a big position. I'll go ahead and start. Whoever wants to start, but. What is one of the things that maybe some people will see that why are these markets so inefficient? Why is it so different than buying Tesla or buying a currency, or regular currency, not a cryptocurrency? Well, what makes it so inefficient?
Sure, yeah. So I think overall it's just that the crypto space has really grown organically, and there was never any infrastructure that was pre-built or relying on old and legacy infrastructure that already existed. So you have all these different companies and exchanges building out their own systems in their own unique and idiosyncratic ways. There's different formats to their ledger. There's different ways that they do the bookkeeping. Their APIs have different functionality, and just consolidating all of that in your infrastructure, I think takes a lot of time and effort. And I think overall, because of the fragmentation of first of all liquidity, because there's so many different exchanges, and then second of all because of the nascency of the infrastructure, makes it so that it's a much less liquid, much less efficient market than what we would normally see. But I think that being said, over time, all of that is going to get fixed. It's just a slow process, and I think it's just a matter of time before you might have some third-party service providers that specifically do smart routing, or specifically do execution algos, or specifically like band together form like an ECN, do clearing. I think all of these functions will eventually form, and it's just it's hard to say when, but I think it's just a matter of just keep at it, keep building, and we'll eventually get there.
Yeah. And I'll add to the fragmentation of technology. I'll go back to regs. Always
Sure.
go back to regs, right?
Sure.
Yeah, so when you buy Tesla, you know what you're getting, right? You know that it's a security. It is listed at the United States Stock Exchange. They're regulated by the SEC. And I think from a regulatory point of view, the issuance of these tokens are just so uncertain. So you have a lot of issuers that come out of the Cayman Islands. They're a utility token, and then the next week they might be, considered a security token. There's another one, issuer in Singapore, and another one in the United States, and it goes on and on and on. And people don't know really how to classify some of these tokens, because some are backed by an asset. So what are those? Like, are they a commodity, or are they, are they futures? And so because from a regulatory standpoint, no one really has identified what it is and even who governs them, right? So in the United States, for example, you have 3 federal regulatory bodies. You have the SEC, the CFTC, FinCEN, and then you have the 50 states. So we don't know which jurisdiction, any of this falls under. That's just within the United States. So I think that gives way to the fragmentation of data that actually goes into some of these platforms. So that's why, you don't see uniform coverage of these tokens across global exchanges, and even more so in the U.S. because, whereas GDAX and Gemini, they have very few tokens. Poloniex
Sure.
just got bought by Circle, and Bittrex have more. but you know, who they're in terms of like risk, in terms of trading platforms, like they're definitely on like opposite ends of the spectrum. So it's going to be interesting how this plays out from a regulatory point of view, because you know that will then affect the data and how it's entered into the system and how it's kind of classified, and hopefully like when that happens, then it can kind of like be uniform and then, you know, scale.
Yeah, I completely agree with the regulatory point, because you know, if you think about it, in the normal markets, there's Reg NMS, which guarantees that there has to be a national best bid and offer, and if you don't have the best price, you have to route it to the exchange with the best price. So we don't have that kind of consolidation of the order books, you know, through, you know, regulation, and certainly not through partnerships between the exchanges. And then, you know, even outside of that, there's a lot of liquidity waiting in the wings. You know, there's tons of these prop shops and hedge funds from the traditional finance world that don't want to touch these things unless there's a lot of clarity around what they are and sort of like what the liabilities of, you know, touching them, getting into them would be, right? So I think, you know, until there is more regulatory clarity, there's a lot of sort of liquidity just waiting on the wings, you know, to see what the SEC says, to see what, you know, the CFTC says.
Yeah, and I want to get a little bit more specific. When I say that my firm does arbitrage and market making, I'll say specifically what we're looking at is we're a U.S., for regulatory reasons, we're a U.S.-based firm. We primarily trade on the U.S. Bitcoin trading pair, and we do that across a few different exchanges: GDAX, Bitstamp, BitMEX. We trade futures on CME. We mostly focus on US-based exchanges and US-based trading. And so across those few exchanges that we do use, there are price discrepancies that we trade on because of an inefficient market and because of a relatively low liquid market. Every exchange has a different price, and that's what Kevin's talking about. There's no sharing agreement, or surveillance agreement, which the regulators want for things like a Bitcoin ETF. That's why we won't see anything like that soon, because of that, and because of overseas things like market manipulation. So Pactum, we focus on the U.S. Bitcoin trading pair. Maybe Tammy, you could talk about what trading pairs you see on your platform, and then Kevin, what your firm does specifically.
Sure.
Right, so on our platform right now, we have USD, Bitcoin, Lumens, and Mobius. We're native to the Stellar's distributed ledger technology right now. So basically, you know, with that, those are the things that we anchor. Like basically, an anchor is a gateway and on-ramp and off-ramp onto this network. But that allows us to scale to 10 fiat currencies that are already on the network. So there's euros, Nigerian naira, Filipino pesos, Japanese yen, Hong Kong dollars, Chinese yuan, and so forth. And then there are, you know, the other, you know, top 10 cryptocurrencies, as well as traditional securities, such as ETFs, municipal bonds, and you know, asset-backed things like gold or silver.
Yeah, so I definitely agree with your point, Dan, about you know, just like you know, how there's a lot of differences between like offshore and the U.S. Right? On one hand, there's a lot of fake volume, you know, coming out of China, coming out of a lot of these offshore exchanges, and then on top of that, you know, where there is liquidity offshore, a lot of times they won't even work with a U.S. firm, right? And they say that, you know, Bitfinex won't work with U.S. firms, BitMEX won't do it either, and I think, you know, overall, to access that kind of liquidity, it's almost like it's pushing business away from the U.S., right? Like it maybe makes sense that as a U.S. firm, you might think about restructuring offshore just to be able to access those liquidity pools. So I think on one hand, you know, having the right regulation would be good. On the other hand, it's also important to remember to foster innovation and to, you know, not just push business off of, you know, U.S. You know, overseas. And then outside of that, I think just more on the regulation front, right now you have all these different tokens, which the SEC has made statements about saying, well, I mean, these could be securities, most likely they are. And I think, you know, there's a lot of question, I think, between, you know, a lot of questions between all these different crypto hedge funds on whether or not, you know, they need to get registered as a broker-dealer or maybe buy a broker-dealer to become one. So there's a lot of questions around that. I think ultimately, it's even then it's a bit nebulous because technically broker-dealers, they trade registered securities. And even if these assets are securities, they're technically unregistered securities. So maybe even as a broker-dealer, you're not really supposed to be trading them, right? So until there's more clarity on that front, I think there's a lot of sort of institutions that are just sitting on the sidelines waiting for that before they really want to get into the market, and then liquidity will improve from that.
And let
Go
me
ahead.
back up in terms of how we're structured, because this is interesting.
Sure.
Yeah. So our HQ is in San Francisco, but our financial institution is actually regulated out of New Zealand. We have 4 entities out of New Zealand, and we're a registered broker dealer that and we have a trading platform that is regulatory compliant that we can actually trade unregistered securities on.
Sure, perfect.
Yeah, and foreign broker dealer and registered custodian. And I will say, because we went down the path, the U.S. regulatory path, and this is why, I know that there's 3 federal things that you need to answer to in 50 states. And so
We all need to go to New Zealand. That's the way to go.
It's like number one place I can't remember who, number one place to transact business. I will say that it took about 12 to 18 months off of our our regulatory infrastructure by doing it that way. And it was interesting, or it is interesting, because we're all we're all startups.
Right.
We haven't been in business for more than 5 years,
Sure.
right? So, as we grow and we're still kind of, shaking out the trees, right? Seeing what's going to shake out the trees here in the U.S. It was very strategic for us to move that way because we can move faster and in a regulatory compliant way in which we were comfortable with.
Mm-hmm. And that also, I think, goes to show that as a regulatory environment gets too stringent, it does start pushing business offshore.
Yeah.
And I think after this, we should all just restructure in New Zealand, if anything, right?
I mean,
is all part.
we've certainly, as a firm, we've looked into doing the offshoring as well. But this is great because this is an economics panel. The economics of it didn't make sense to us because we were mostly servicing U.S. clients. We didn't have a huge amount of demand overseas. As traders, we just can see the manipulation in the market, and therefore we're very selective on the exchanges that we use. I listed the exchanges that we use, so I have a differing opinion on all the other ones that exist out there. Mm-hmm. So for us to do overseas and to work with overseas exchanges, it's just not something that we would do right now, mostly because of the manipulation we see in the market. Mm-hmm. That being said, I will say that what we have seen over the past year in terms of the price going very high up and now declining rapidly is a function of the amount of manipulation that does exist in the market. Cryptocurrency, as someone who, and as a firm that we don't really hold these assets, I can say unequivocally that this stuff has been highly overvalued. I don't see the fundamental value of a Bitcoin that's worth $15,000 right now, and that it's been mostly based off of manipulation. Now that's my firm's thesis. I don't know what you guys. I'm sure if you guys
I have
something
2 questions to ask you.
Sure.
Is JP Morgan a U.S. based entity?
It probably isn't if I really looked at the charter. What's your second question? Because you're going to give me 2 answers, I know.
No. Do you think JP Morgan, with the CEO's statements earlier or in late 2017 were market manipulation for Bitcoin, right?
Not to the level of I mean, he's just making statements. This is what I'm talking about is things like wash trading, spoofing, the things to that effect. There's a lot of people manipulating the market through Twitter, social. It's very interesting, this combination of cryptocurrency and social media, the things that we're seeing. So, was he manipulating it? Yeah, because he's on the side of not holding any cryptocurrency, not trading any cryptocurrency. Therefore, his firm has a very different thesis, and he's just pushing his own agenda. That's what folks do.
So Jamie Dimon is talking his book, right?
Yeah.
So
You,
it makes
see,
sense.
you said that in one sentence. I had to explain it in a paragraph. But so that's your take on manipulation, which is the banks do it too. And then so, Kevin.
Yeah, so I have a thought on that too, which is that, I won't name the names of these exchanges, but I noticed that on one exchange for a pair, they were trading some amount of volume per day. Just looking at the liquidity in the books, it was some amount. And I looked at a different exchange and it said it was trading 2 times the volume, but with 1/2 of the liquidity. Right, so it's a 4x difference. In my opinion, that can't really be explained naturally, because I don't think that you could. People are really like, is it really the case that between makers and takers, right? So takers are people who take liquidity on the markets. Makers are those who make liquidity. Is it really like a 4x difference that there are that many more takers on this one venue than there are on the other venue? It's just very hard to believe, right? So it leads me to believe that there's a lot of wash trading going on, where people are just crossing, bids and offers just in the mid price, and nobody's actually, buying or selling and taking long or short positions. They're just washing. I think that's one point of evidence. So I definitely agree that I do think there's a lot of wash trading on these exchanges.
And I think the most problematic and perhaps nefarious thing that's happening is that the market making that's being done on the exchanges is being done by the exchange itself, which doesn't make a whole lot of sense. You should have firms like Kevin's or mine work on the market making side of it, where we're incentivized to make a spread, not to have gigantic volumes that show up in the news media, and therefore retail investors then go use your exchange. That's really problematic. So there's an opportunity here, I think, with cryptocurrency to be a trader in it if you are skilled at doing that in equities or Forex. But the buying and holding of it, I would be very cautious of. If you want to buy it and hold it for a long, long time, maybe there's some benefit to that. But in the short to medium term, I'm not a financial advisor, but I wouldn't recommend it if you expect gigantic returns. I don't think that this is a get rich quick thing. And as you can see, like the way that the markets are behaving now, we're seeing a lot of retail investors, I believe they're starting to sell out because the valuations were inflated. So.
Yeah, definitely.
I feel like you had something to say.
No, I can't. I just wanted to comment.
Now you remembered it.
Oh yeah, I remembered. I was like,
you're like this, and
then I forgot. Okay, no, I would just say to offset that comment is that I would in traditional capital markets, particularly, I'll use Morgan Stanley as an example. Morgan Stanley is, they do have their own products, they have their own trading platform, but they do market making. So I think in traditional financial markets, you do see trading platforms do their own market making.
But Morgan Stanley doesn't own an exchange. That's still the same debate that I'm. Morgan Stanley is market making on exchanges that are not their own, like the New York Stock Exchange.
Oh, yeah.
Yeah. So I will say, though, Stronghold is something that folks can use. You are actually solving a problem where I think people who own the Stellar asset or its derivatives, such as Mobius or some of these other ones, they have somewhere to keep it in a wallet, which there isn't very many retail offerings for that. So maybe if you could talk a little bit about that. What it's like to run that kind of business, what the economics are of that, versus having like a bank account or something. Is it more economical to store digital assets versus digital cash in a ledger? Is there a difference to that?
Is it more economical for somebody to hold?
For you as a company.
For me as a company. For
running a company versus like a bank, is it more economical to store digital assets versus cash?
Right.
Cash is expensive to store, actually.
Yeah, and so is custodying of Bitcoin.
Right, that's where I'm going. So my understanding is that you do custody.
We do.
Kevin, I don't know if you do custody. We don't do custody. We looked into custody. We don't do custody.
We don't do
You're the
that.
only one that does custody. Mm-hmm. Let's talk about custody.
Really? You're going to talk about custody on stage?
Why not? You don't want to?
No, let's do it.
Is it not economical?
It is. I think that we're really lucky in terms of the protocol that we use. I used to be the first head of growth at Stellar in 2014. So I've been building on this particular distributed ledger technology from the beginning. And I will say that, since we use this protocol kind of to store the assets, it already has, seven signature, like multi-signature wallet built into the protocol, as well as like hardened deterministic keys. Custodying of like Stellar and the assets native to that network they make it pretty dead simple. It's kind of like open.
I've used your
BitGo.
platform. It's really simple.
Yeah, it's pretty dead simple to do that. Now, with things that are not native, like Bitcoin and Ethereum, we can put those into cold storage. But what makes us a little different from other custody solutions is that we actually tokenize the asset and put it on the ledger. So there's actually two ledgers of the asset. So there's Bitcoins on their native ledger, but then that Bitcoin is represented on the Stellar's ledger. So once it's on Stellar's ledger, this Bitcoin can go like into cold storage. So, what happened, fast forward and there's a bull market, right? And then all of a sudden there's like a price spike or like everybody's selling off. Sometimes it takes like 24 to 48 hours to kind of get that asset out of cold storage. But since that token is already digitized on our platform, you can continue trading it while it's coming out of cold storage, and you don't actually have to have the asset like on hand to trade it. So that's something that's a little different than about us, which is kind of favorable to traders who are active.
It's a little bit like tethering up Bitcoin.
Yeah, that's exactly what it is.
That's awesome.
Yeah.
That's awesome.
So we're almost out of time, but I think we wanted to take some questions. I'm hoping that there's some questions. Please ask us some questions. I heard you talking earlier, Mr. Blue Shirt, so you...
Dan, I have a question for you.
Sure.
That Bitcoin, the crypto ETF will not be approved
No.
because of market manipulation.
Yep.
Now, can you tell me, in your opinion, when and how would market manipulation be getting rid of in the market? Because it's really hard, I would think.
Yep.
So in your opinion, when would a Bitcoin or ETF be approved by SEC, or if ever?
Well, I think it'll happen at some point, but we're so far off from that right now. I wouldn't even be able to give you a date. There's just a lot of manipulation going on. There's a lot of Justice Department investigations into manipulation, and I don't work for the government, so I couldn't tell you when they're going to finish all of that work, which is going to be a lot of work. I think there's a lot that has happened in this market that the average retail investor isn't aware of, that has been unfairly tilted the tables towards those who have inside information. These things happen in the regular markets, but the regular markets have a lot more rules. It's really a lot of the Wild West that we're seeing right now, and none of that's going to change until there's a lot of penalties put across. And I think also, to give the government credit, it needs to do a lot of investigations and a lot of work to figure out what's been really going on.
Do you think it's several years?
Yeah, I do.
I would imagine that the investigation...
It could be 5 years.
Yeah.
There's going to be a lot of infrastructure that needs to be put into place from a regulatory perspective for there to be a Bitcoin ETF.
The price of Bitcoin from $1,000 to $20,000 occur really rapidly. And I would think that the investigation into market manipulation would probably take several years.
Yeah, but I also would say...
It's going to be like an indictment, like, whoa, these people.
Also, though, you're talking about a lot of zeros there, but the multiples have always been the same. So this volatility has been going on since I've been in this market for 5 years. So just because it went from 1,000 to 15,000, I mean, we saw 100 to the same. You're just adding zeros to it. The multiples haven't changed. And the government hasn't done enough to get the regulatory regime in place, but that's because they also don't have enough knowledge to make those decisions, I don't think, to their credit.
So what is your opinion when people say that, well, the Bitcoin ETF will be approved soon? You're saying it won't be. Because
those are people that probably own a lot of Bitcoin and want to see the price of Bitcoin go up.
I see.
And I don't have a problem with the price of Bitcoin going up, but I also don't have a problem with the price of Bitcoin going down because we're just active traders in the market. We don't own Bitcoin.
Right.
So we have a different position than maybe somebody who owns 1,000 Bitcoin.
I
They
see.
want the ETF, but they're not willing to wait the time for this market to marinate and to get enough regulatory understanding from the actual regulators for them to make the right decisions.
Right. Thank you.
You're welcome.
Tammy, you referenced token tax optimization. I'm wondering, are you a tax advisory service that's providing information to clients on buying, selling, and exchanging cryptocurrencies? What did you?
No, we have one specific product
Okay.
that is, it's a trust. It's a trust product, and it's available just because we're like a New Zealand entity, and we can basically, if you're an issuer and you're a founder or you're an advisor, it's our understanding that you have to. There's really no like 83B. For these in cryptocurrencies. So you would basically assign those tokens to a trust company such as ours, and we would hold the tokens in trust for you, and you wouldn't be obligated to pay taxes until the time of liquidation, and instead of like vesting every 4 years. So that's what that particular product is about. And the only reason why we came up with it is because we used it internally. So we're basically using something that we've structured and, offering it to the public.
Are there any other questions? Or Brett?
I thought I saw one there in the back. We're good on time.
Okay. I know there were other questions. Come on. No?
There's one over.
So just on the point of market manipulation, so I think it's kind of ironic and hilarious because I thought the whole point of blockchains was greater transparency and everyone had to follow a transparent protocol. So what are your thoughts on interchain decentralized exchanges in the sense that, because you could, right now you could theoretically stick some funds interchain onto some VM somewhere where execution is transparent and provable. I would think in some point in the future you could actually do it in production and with like industrial grade engineering. What are your thoughts on how that will affect fair manipulation of the market and potential adoption, especially from trading firms like yourself?
I do have experience in, Stellar's pretty fast, right? And we're on distributed ledger technology, so every transaction is kind of out there in the public for people to see. And I will say that, from traditional capital markets or even some of the larger exchanges, that there's only 4 exchange that has this API called FIX protocol, and it's financial information exchange protocol that's used like by the CME and NASDAQ and other folks that want to do like quant type trading. And I will say that while to my knowledge, Stellar is the fastest like distributed ledger technology out there. It's still not and will not be fast enough for quant traders. Like they want execution engines that are in milliseconds, and they want to have co-locations like on in the New York Stock Exchange compounds. So while it will serve one audience, I don't think it can serve another. So it'll be interesting to see how it all comes together or if it can serve both markets, right?
So I think if you look at 0x as a protocol, the way they do it is they have the order relay in a centralized way, but the settlement happen in a decentralized way. And the reason they do that is because you don't want to have to pay the gas fee on the Ethereum network every time you open or close an order, when it isn't hit. So it gives a lot more leeway for, I think, market makers to follow the market and adjust their quotes and provide liquidity in that way. So I think that, as a baseline, I think that's a good way to think about it. I think really the decentralized exchanges face this other problem where there's just not that much liquidity there, and liquidity begets liquidity, right? It's very hard in a normal situation for exchanges to take market share away from each other. I think, overall, Kraken and Bitstamp made their business when Gox fell apart. Bitfinex made their business because they introduced margin trading. Poloniex listed more coins, Bittrex listed even more, and then Binance listed even more, right? So I think under normal circumstances, it's very hard, to get liquidity in an empty book. So I think, is it that, so the idea behind decentralized exchanges is that you no longer have custodial risk, right? You don't have to worry about the exchange getting hacked. Your funds are in your own wallet, and you can do an atomic swap or some kind of, smart contract to do the settlement, where one side is always swapped for the other, and no single leg can settle without the other. But what's the real value there quantified, right? Like if the risk of an exchange, a major exchange getting hacked, let's say generously is 5% a year, right? And let's say that since it's such a bad event, let's just double it in terms of its effective badness, right? So if the decentralized exchange prevents that, it's making maybe a 10% marginal improvement over what the centralized exchanges can do. So I think overall, maybe, it's not enough to adopt a new technology, because there's definitely these big barriers for entry in order to even integrate a solution with decentralized exchanges, at least for the vast majority of folks that are even outside of the crypto space. So do people really adopt a new technology for being 10% better? I think usually it's something like 10x better when they adopt something new. So I think that's a hurdle that needs to be overcome. Now I think with folks that are already in the trading space, that are more familiar with technology, at an institutional level, I think you could definitely have some kind of dark pool, which is decentralized, or some kind of decentralized block trade settlement, crossing network, or some kind of ECN. So I think there's definitely something to be done there on that side, but for it to gain much wider adoption, it'll be difficult.
That was a good question. I forgot to ask that during the panel, so thank you.
Excellent. I think we had one more question over here. I don't know.
You were talking about wash sales. What's the benefit of the person doing the same wash sale? Why are they checking that?
Could you repeat the question to the audience if you heard it?
I heard part of it. It's something.
So, one second. We'll run the mic there.
Why
real quick.
would,
Let's just, yeah.
he's asking?
You were talking about liquidity and people repeatedly doing wash sales to affect the market. What is their profit benefit? Why are they trying to do that?
Oh, I don't think it's so much that there's a profit benefit. So I don't particularly call it manipulation. I would call it it's just bad. I mean, it's just, fake volume. I think what it is that the exchanges promote this in order to have better standing in the rankings on CoinMarketCap. And I think it's really, I've even heard an exchange call it marketing spend. So, I think that's really what it's about. It's about showing people where, the action is. It's sort of like the bright lights and blinking lights at a casino, just to attract more people to it, to do more trading. So I don't think it's as much to move the market in a certain way as it is to just bring more volume onto that exchange from actual real traders.
I agree.
Yes, what he
Excellent.
said, for sure.
On that note, let's thank the panel here. Round of applause. Okay, one final question for Dan here. So where is happy hour this evening?
Yeah, so I didn't get the email, and so I complained to Brett, and so I guess it's my job to tell everybody, you better hope I get this right.
Hope you
but I
do.
believe it's at my favorite airport bar, Houlihan's, at the
Houlihan's.
Holiday Inn, right down the street.
Right next to us.
Right next to us.
Yeah, so what time does this event start?
I think it's as soon as you say so. It's 5, because you put up 5 fingers. I assume that's 5 o'clock p.m.
We're doing well.
Pacific Standard Time.
Yes, exactly. Pacific Standard Time, not to be mistaken.
Hey, we're global here. It's
We're global.
cryptocurrency.
Global, yeah. Okay,
24 hours.
So post this event. We'll get posted up there and have a couple beverages and discuss the learnings of the day. So with that said, let's give them another round of applause. Excellent panel. Thank you guys so much.
Thank you.